Wanted to talk today about refis because with the interest rates starting to fluctuate and starting to stabilize and maybe come down a little bit, maybe they went up a little bit recently, but I know I've got my clients calling me say, when should I even consider it?
This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
You know, I bought 2 years ago and I got a 7.5% interest rate. I don't know when I should at what point? Okay, what's the answer to that? So is there a spread? Tell me how to think about whether or not I should be considering refi.
I think there's a standard logic to it as far as if you're looking to justify it sort of mathematically. My answer would be with the larger loan sizes that we have now, where you're borrowing, $400,000 and $500,000 on your mortgage, this sort of thing, 0.75% to 1% is usually a winner for people.
Okay.
So if I can drop your rate by 0.75 or a full 1% or more, you're likely to win on that.
Okay.
And the caveat to put around it is, I'll tell the audience that if you refinance your house and then sell your home 6 months later, you made a mistake.
Right.
So if you can't keep that house, my rule of thumb would be at least 3 years, because that's the general math. You shouldn't refinance. I don't care what your interest rate is. If you are going to sell it in the very near future, don't touch it, because you're going to waste money.
Gotcha.
Right? And that's absent any other factors.
And that's because of the amortization of the principal, or
well, there's costs that you're going to have in refinancing, and you need time for the lower interest rate to reimburse you for those costs.
Gotcha. Okay.
Right? So you need the mechanics of that. If you can lower it by 0.75% to 1%, you're going to recoup your costs in somewhere between 18 months and that 3-year mark, and so you're very likely going to benefit from that refinance in the longer run. Maybe not on day one. And this is a little bit of a sort of a trick in mindset. There is, yes, your monthly payment went down $100, $200, $300, this sort of thing. I understand you may feel that, but you added to your loan balance, or you spent the costs of the refinance that you're still making up before you really saved $1.
Right.
Does that make sense?
Yep, I get it.
That's one perspective.
Okay.
The second, and I'm sorry, we in the industry, we call that a rate and term refinance, where you're trying to improve the rate or the term of your mortgage. So going from a 30-year to a 15-year and so on, all those type of things.
Gotcha.
The second type of refinance that's out there is a cash-out refinance.
Okay.
Now, we've been lucky enough, for those of us that have been homeowners for the last number of years, to have awesome appreciation in these homes, right?
Yep.
And then you've built up a lot of equity in there in many cases, and so Americans are given the opportunity to potentially refinance their home, take some cash out, and wipe out other debts to pay for their kids' college, to set aside a safety net of money, to put money aside into your retirement account or some other investment, right? All these sort of things. The bar for doing a refinance when you're taking cash out is different than simply what the rate and terms have, where, hey, I want my payment to be lower. Because in this case, you may have your monthly payment go up and your interest rate not even change tremendously, but you're able to take that cash and wipe out a bunch of other debts.
Right.
So I have $50,000 in other debts that has a $2,000 payment per month. I can wipe that out, but my mortgage only goes up $200 or $300.
Gotcha.
Right? So my cash flow on a monthly basis can be greatly improved and be a real valid justification for doing a refinance, even when you're not improving the interest rate.
Gotcha. Okay.
And I'll tell you, there are many people right now that are really faced with an even tougher layer decision, which is they have a 2-something interest rate, they have a 3% interest rate, and they don't want to give that up.
Right.
But their equity in the house is trapped, and they have all this other debt. You can absolutely financially justify giving up that 3% interest rate and taking a 5 or a 6, let's say, if you're able to wipe out a bunch of other high
22%, 24%.
Exactly right. High interest rate debts.
Yeah. Because credit card debt's out of control right now.
It's massive. I mean, it's $1.1 trillion in the United States for revolving debt.
Yeah, it's crazy. Yeah, so if you can get rid of that 24%.
And that's separate from auto loans, and this is just credit cards.
Yeah, just credit cards. Yeah.
So it's absolutely a financial benefit to those consumers who have that ability.
Okay, so I mean, a lot of people out there are asking me, they're first-time home buyers, John, and they say, "Gee, when I bought my home, there was a lot of closing costs involved. Yeah. So when I do a refi, is it going to cost me just as much? How much should I expect to spend on a refinance?"
I would tell you it's a few $1,000s.
Okay.
Probably in the neighborhood of $3,000 to $5,000 of sort of mandatory expenses in like a average priced home.
Okay.
And what we're talking about there are lender-related fees, title and escrow fees, property taxes, home insurance, this sort of stuff. All those things are real costs that you're going to experience when you do a refinance. They don't simply go away. And so I guess talking to the audience here is, I want you to know, don't let somebody tell you your refinance was free.
Right.
Or it's a no-cost refinance. Yes, it may be no money out of your pocket.
That's right.
But there are costs to doing
it's increasing
this.
your principal or it's affecting the new rate.
Absolutely.
One or the other.
Yeah, well, we have multiple ways we can move dollars around and move it into different buckets, so to speak. But there is an expense to doing this.
So like anything else you do in real estate, pencil it out. Let's pencil
100%.
it out. Let's just take some time, figure out, okay, here's my payment now. Here's my principal balance now. If I refi, here's my new payment. Here's my new principal balance. And here's how much of a check I had to write. And how long is it going to take me to recoup the check I wrote and the new principal or the new principal over time to make up that difference. That's the math you need to do.
Right. And it's certainly something we do with every single one of our clients. And I will say that that sort of refinance wave has begun for our industry.
Yeah.
Where, people who had 7.5, this sort of thing, they're absolutely benefit from doing it right now. And we expect more and more waves of people will benefit from these as interest rates fall, assuming they actually continue down that path.
Right.
And so this is going to be something that a lot of people are going to benefit from as we go forward. Where it's sort of interesting and is most challenging is people who recently purchased their house or recently got the loan that they have and they're looking to improve that. Now that's a bit tougher because like if you just purchased your home, let's say, and you did the minimum down payment to buy that house, there's not a lot of equity after just 6 months time typically, right? And so there may not be enough room inside the value of that property to build all the costs into your new loan amount. So you could possibly come out of pocket with some dollars, and it may justify and it may not. We have to do the math.